Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Oil hits a new wartime high on concerns the U.S. may resume attacks against Iran. The U.S. military has asked for hypersonic missiles to be sent to the Middle East, the first time those weapons have been deployed. A divided Fed. Jerome Powell's last meeting as chair sees rates unchanged, but dissent over its easing bias. Powell says he will stay on as governor. And AI earnings impact. Alphabet and Amazon see a payout from their artificial intelligence spending, while Meta lags behind. It has just gone 8 a.m. across the Emirates. I'm Johanna Bersachi in Dubai. So much news to get through this morning, and a tale of two narratives between the AI tech trade, which is breaking out to the upside, and oil, which is also breaking up to the upside. So we're going to get through all of that in just a moment. But I just want to tell you we're getting some European earnings come through from the banks. BNP Paribas coming in at 3.22 billion euros for the first quarter net income. That is higher than estimates of 2.92 billion. They are guiding to a return on tangible equity for 2028 of above 13%, but for this year at 12% for the full year. In terms of revenue, they've also beat to the upside. First quarter revenue, 14.06 billion versus estimates of 13.79 billion. It doesn't stop there. That was BNP. We are also getting numbers from Standard Chartered. First quarter pre-tax profit, $2.45 billion versus estimates of $2.09 billion. So a beat coming through also for Standard Chartered. First quarter operating income at 5.9 billion versus estimates of 5.58. So a continuation of the theme of banks beating to the upside. Standard Chartered saying they will set out the next phase of growth at an investor event. First quarter credit impairment charges 296 million. So bottom line is both earnings that have dropped at the top of the show. BNP, Standard Chartered, a beat on the top line and also the bottom line. But let's broaden this out and talk about markets more broadly, because we've had an eventful overnight session. Not just the Fed and the fact that we had a few dissenters on the easing bias. So we'll talk more about that in a moment. But ultimately, a hawkish reaction to markets. And we saw a bit of a dip for Wall Street indices yesterday. And then, of course, all of the Magnificent Seven earnings dropped, too. In after hours, just to tell you, we have Alphabet rising 7%. Meta dropped 7%. So a tale of two stories there. Amazon climbing around 3%. And Microsoft basically unchanged. So those are the big ones that dropped overnight. And we also have Apple to watch out for today as well. Now, take a look at Brent. All of the action in oil this morning, up 5.5%. We are at $125 almost. This is clearly a new war high for the commodity, but then also the highest level we've been at in 4 years. You have to go all the way back to 2022. And just, I'm just going to give you one number. The price of crude has doubled this year. It is up 100%. And why? What is the catalyst this morning? We'll get into it in just a moment. But ultimately, looks like President Trump has rejected Iran's offer of a mutual lifting of blockades. And now there's real talk about a potential flaring up of hostilities once again. So oil markets are reacting to that this morning. And then two-year yields, we are, again, reacting to, number one, the inflationary pressures coming through from oil, and then also some of the hawkish language and hawkish messaging that came through from the Fed yesterday. We scaled up 11 basis points higher throughout the course of the Fed meeting in yesterday's session. So all that is going on. Let's talk about the price action in Asia, too. Avril in our Singapore studio. And I guess much the same with some of these markets over here, Avril. It's a question of which narrative wins today. Is it the oil trade or is it the AI trade?
Yeah, there are so many drivers in the markets today. To your point, we also have the Max 7 digestion, right? So the takeaway from that is, yeah, AI demand is strong. And indeed, today you saw Samsung, that profit beat. And in terms of how you had a 48-fold surge in chip profits, that initially left the stock opening flat, more or less. But you're actually pulling a bit lower now. And I think that speaks to the sense of caution following on from that headline, following from Axios reporting that the US is mulling those military options in Iran. So you're read across most of the indices in the region, and then you add to that what we already saw in the oil price gains on the likelihood of the extension of the blockade and the relatively hawkish Federal Reserve. That was a double, maybe triple whammy, some might call it, on bonds as well. You are seeing, as I'm showing you here, the 10-year yield in Japan, but note a lot of the repricing was on the front end of the curve. That being said, we did get really good demand for a 2-year auction today, so maybe that allays some fears in the meantime, but we are also tracking dollar yen, as you know how it popped above the 160 handle to the weakest level against the greenback since 2024 at one point. So you're moving sideways for the moment. A number of things that we're watching in the session today, Jumana.
Yeah, yen at 160, certainly higher oil prices and a hawkish Fed not helping there. Avril Hong in Singapore, thank you. Well, President Trump has told Axios he will not lift a naval blockade of Iran's ports until he secures a deal with Tehran to address the country's nuclear program. The outlet is also reporting that the U.S. president is slated to receive a briefing on new military options later today. Trump says he has rejected the latest proposal from Iran to reopen the Strait of Hormuz. Joining us now is Stuart Livingston-Wallace, Bloomberg's executive editor for Middle East, North Africa, and Russia. I mean, judging by the price action in oil today, Stuart, the market seems to be accounting for, once again, a potential resumption of hostilities.
There's been sort of a series of reports that, the Pentagon is planning a series of, either it's going to be a series of very precise strikes, or it's going to be a sort of a furious attack, basically to try and push Iran to get to the negotiating table, or at least rather to make serious concessions that the US can sort of move forward and again, lifting this blockade. This blockade has now become the central focus, I think, of all parties, and I would argue the entire world, because it's having these ripple effects across every industry, every economy.
I mean, in retrospect, it seemed unlikely that President Trump would be willing to lift the naval blockade, because he himself had painted that and framed it as being very successful, and that it was, cutting off a key lifeline for the Iranian economy.
Yeah, except, I mean, it depends what else was on the table. So if, for instance, hypothetically, the Iranians had come in and said, well, look, we want to discuss these two key issues, that is Hormuz and the nuclear file, simultaneously, and we'll make these interdependent. Maybe there was some wiggle room there, but what they were trying to do was, we'll deal with Hormuz and we'll deal with everything else further down the line. So that clearly was never going to wash.
Stuart, our defense colleagues have reported that the U.S. are looking to move over some hypersonic missiles to the region.
Yeah, I mean, interesting on two counts. Number one, again, further evidence of equipment being moved into the region. It's exactly what we saw in the run-up to the Feb 28th move. Now, there is a counter-argument here in that one of the aircraft carriers, one of the three that are in the region, is reportedly going to go back to port for maintenance. It's been out at sea for something like 10 months, which is a record. Nonetheless, the fact that you go from 3 to 2 shouldn't be taking a signal of détente. But the hypersonics are interesting, partly because, this would, if they are deployed and they're seeking permission still, be the first time they're deployed in a hostile environment. These are incredible bits of kit. As we were discussing before, 5 times the speed of sound. I think the average commercial airliner at cruising altitude is something like 80% of the speed of sound. It's very hard to get your head around how fast these things go. So very difficult to stop.
Okay, Stuart, thank you so much. Stuart Livingston-Wallace, Bloomberg's executive editor for Middle East, North Africa, and Russia on the latest. Now let's turn to the Fed. Jerome Powell will stay on at the Fed as a governor when his term as chair ends. Officials left interest rates unchanged at 3.75% in Powell's final meeting as chairman. There were 4 dissenting votes, revealing a deepening division on policy outlook driven by uncertainty on the conflict in the Middle East.
We think our policy rate is in a good place. People are not saying we need to hike now. I don't think there's much of a case for any case really for policy looking, meaningfully restrictive, maybe mildly restrictive or neutral. I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair. The things that have happened in the last 3 months have, I think, left me no choice but to stay. I am confident, as I said in my remarks, that the Fed will continue to make its decision based on analysis, rigorous analysis, and not on political considerations, but we've had to fight for it.
Meanwhile, President Trump's nominee to be the next Fed chair, Kevin Warsh, has won the backing of the Senate Banking Committee. The vote was 13-11 on party lines. It puts him on track to be confirmed by the full Senate before Powell's term ends on May the 15th. Joining us now is Anita Krishna Gupta, Wealthbrix Capital Partners CIO. Well, Anita, I'm going to start with the oil move this morning because it is significant. We've just in the last hour traced $5 higher. And I thought it was interesting yesterday that Powell said the peak of the energy shock has yet to come. You had 3 members on the committee dissent because they want to remove the easing bias. Is the Fed about to turn a lot more hawkish? I mean, you saw the hawkish price action yesterday in the front end of the yield curve, but is that the correct read, do you think?
Yeah, so good morning, Jumana. I think that's absolutely the correct read. So while they have not raised rates, I think the tone of the Fed is definitely tilting towards the hawkish side. So you've got a dissent yesterday, 8-4, with 3 members, saying remove the easing bias commentary. Now, I kind of agree with that because the Fed insists that, inflation is transitionary. Now, if you are looking at a continued blockade of the Strait of Hormuz, which is about 20% of the oil supply, you've still got about 11 million barrels of oil missing, of course, not counting LNG, urea, phosphates. So you're getting that inflationary impact. The Fed also spoke of the fact that for March, headline PCE inflation was at 3.5%, core was at around 3.3% year on year. So that inflationary impact is coming through. Now, how transitionary is that even once oil prices come down, you still have that short supply of oil, gas, and other, necessary, ingredients for crops. So I think the tone is hawkish for sure.
Yeah. Okay. How high is the bar for them to hike?
I don't think we have any hikes in, coming forth because...
So why not, though?
Because the Fed has a dual mandate. One is unemployment, okay? And focusing on unemployment is currently around 4.3% in the U.S. So that's going to continue to be one of their mandates, and the second is they do look at inflation and they would like to keep, consumer prices constant. Now, if they're looking at that, hiking rates is not great for corporates. So they would probably continue to maintain this, hawkish bias, but keep rates flat. And we are still looking at, if the Strait of Hormuz opens, if oil prices start coming down, then they would do a cut towards end of the year.
Okay, we had a series of big earnings drop overnight. Yeah. And I wonder, as someone, I know you're invested in the AI trade, whether what you got yesterday out of the likes of Alphabet, Amazon, Microsoft, Meta, etc., Meta obviously trading negatively in the after-hours session, whether you think that is enough to keep the AI trade going?
So we are describing the market as a combination of caution, dispersion, volatility, and resilience. So what we are seeing from these Mag 7 big tech, again, tech across the board globally, whether it's Korea, Taiwan, Japan, and of course the US. So we're seeing that resilience in earnings. So we're looking at a 22 to 28% growth, whether it's cloud revenue, whether it is again, driven by ad spend. So ad spend stays constant, but again, Meta has to kind of capitalize on that and show that in the form of revenue. But we're looking at, Google talk of $20 billion, revenue coming in now from the cloud. So while they're talking of data center spend, which is roughly about now their total capex spend amongst, the big 7 is around $775 billion. Now, that's not small, but it is coming through in the form of revenue. You're talking of Alphabet talking of a 20%, revenue increase year on year for this quarter. You're seeing Microsoft coming out with good numbers. You're seeing the same, again, coming through, probably will come through from Apple, though, of course, worries are there.
The point is the capex spending is translating to revenue growth from what we can tell from the latest set of earnings.
Yes, absolutely. Yeah.
Okay, so let me ask you something else. The run-up in semiconductor stocks, is that justified?
Absolutely.
It's been vertical.
Yeah, so actually the global semiconductor index is up 150% in 1 year. It's up over 53% this year.
Yeah.
And I think that is, not surprising, considering that if you just look at one stock, NVIDIA. Now, NVIDIA is, growing earnings at 24% for this quarter, expected to grow the same for the year. It's actually responsible for a big chunk of the S&P 500's earnings growth. Now, the similar is true with TSMC, Samsung, and, different kinds of memory that I used. It is the requirement for compute. I don't see the trade going away, but do expect a little bit of volatility.
Okay, let's go back to where we started, which is the energy price shock.
Yes.
Is that not a bottleneck for the scalability of the AI trade?
Absolutely. That's why I said caution, because we have to look at the market with caution, because the oil price shock is absolutely feeding into corporate margins, into transportation, into supplies of goods. You've got higher oil prices affecting Asia, oil importing countries, more than they are affecting self-sufficient energy regions such as the US. Now, it is going to impact the AI trade because at the end of the day, everything is about demand and supply. If you have slower global demand, chips also will definitely come down.
Anita, always good to chat to you. Thank you so much. Yeah. Anita Krishna Gupta, CIO at Wealthbrix Capital Partners. Well, coming up, a frenzied day of earnings reports offers a glimpse at how some of the world's biggest tech companies are doing in AI. As you were just speaking about with Anita, we're going to break it down in more detail next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Shimana Versace in Dubai. U.S. big tech stocks are under scrutiny as heavy AI spending delivers mixed results. Alphabet is seeing a clear payoff from its AI spending, while Meta is lagging behind. Let's bring in Bloomberg's Neil Campling for more. I guess one of the questions we had going into this earnings season, this earnings week for the Magnificent Seven, is whether we are actually beginning to see the investments in AI pay off, i.e., is there monetization taking place for these hyperscalers? What have we learned in the last 24 hours, Neil?
Yeah, this is the trillion-dollar question, I suppose we could ask. For evidence of whether the payoff is coming through, I think the first thing to look at is the associated revenue growth, the top-line growth for these big tech companies. We can see this quite clearly in Google. They've had an acceleration in their cloud growth, up 60% year on year in the print last night. Their backlog is up 100%. By comparison, Microsoft's Azure is up 38%, still a very good number. Meta's sales are lower growth at 33%, and Amazon's AWS was up 28%. So Google grew nearly twice as fast as the other big tech companies. And that's evidence that they are succeeding in terms of that ROI payoff for the AI CapEx investments.
Why? Why is Alphabet
the main reason
more than rivals?
Yeah, I think if you look at the technology stack, so Google has a fully integrated vertical AI stack. In other words, it has the chip layer, it has the infrastructure layer, and it has the application layer. So the questions that were asked maybe 3 to 4 quarters ago as to whether you had the full stack, Google's top line, Google's results prove that they have that particular stack. And the key thing, and one of the differences, is that it's also fueling the core services. So you're seeing an acceleration in core search at Google because it's using the AI toolsets across the entire organization.
Meta, the underperformer in extended trading, but at the same time, they are also guiding to even higher capex. So what is driving that?
They have an issue in terms of some of the numbers there, the KPIs, as we call them, in terms of the daily active users actually went down last quarter. That's an issue. So it doesn't really justify the higher capex spend. If we look under the surface, the biggest reason for the capex increase is probably actually because of the cost increases, primarily around things like memory. And we see the other side of that coming through this morning in that Samsung's semiconductor business had that 48-fold increase in profit. So higher memory pricing feeds through into the higher capex spend that the likes of Meta is having to put through. And again, we're not seeing that coming through in terms of acceleration of top line. So the questions over whether their returns will improve is a big overhang on the stock because it's not happening. It's not helping keep people and on their platform. That's a big problem.
Yeah. Bloomberg's Neil Campling, thank you so much for breaking it down for us. Super useful analysis of what we got yesterday from the earnings. All right, still ahead, the Iran war is now fueling a resurgence in maritime piracy off the coast of Somalia. The full story coming up. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johannesburg in Dubai. Now for a look at some of the other stories we're following today. Sources tell Bloomberg that Anthropic is considering a fresh funding round that would value the company at more than $900 billion. The AI developer is said to be entertaining investor interest that could more than double its current valuation. The talks are at an early stage and no offers have been accepted. The move could allow Anthropic to leapfrog its rival OpenAI to become the world's most valuable AI startup. Fidelity Investments is dialing back remote work. The asset manager will require most U.S. employees to be in the office 5 days a week starting in September, ending a more flexible work-from-home policy. The mandate covers thousands of staff across Boston and several other states and comes as Fidelity expands into new office space in Boston Seaport. The firm says being together in person boosts collaboration, mentorship, and learning. Shares of Bill Ackman's Pershing Square USA plunged 18% in their market debut after a combined IPO of the closed-end fund and his alternative asset manager. The deal raised $5 billion, just enough to keep early investors in, but far short of the $25 billion Pershing Square once targeted. Ackman says the fund should eventually trade at a premium if it delivers the same outperformance as his hedge fund firm. And some more earnings just crossing right now. I want to bring you SocGen figures. First quarter net income at $1.7 billion versus estimates of $1.55 billion. So another beat coming through from European banks. First quarter beating estimates, as I just mentioned. Let me bring you some of the other figures as well. Net banking income at $7.11 billion. That is pretty much in line with the estimate of $7.19 billion as well. Markets, interesting. So that has come in slightly higher than estimates, $1.87 billion versus estimates of $1.86 billion. And fixed sales, trading and revenue. So there, obviously, a big focus for the French bank. Derivatives exposed, $571 million. That is down 18% year on year and is a miss versus the estimate of $665 million. So that's it from SocGen. Coming up, we're going to talk more about energy markets and the UAE's decision to quit OPEC, which is seen driven by its worsening rift with Saudi Arabia. We'll discuss next. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Oil hits a new wartime high on concerns the U.S. may resume attacks against Iran. The U.S. military has asked for hypersonic missiles to be sent to the Middle East, the first time those weapons have been deployed. A divided Fed. Jerome Powell's last meeting as chair sees rates unchanged, but dissent over its easing bias. Powell says he'll stay on as a governor. And AI earnings impact. Alphabet and Amazon see a payoff from their AI spending, while Meta lags behind. It's just gone 8:30 a.m. across the Emirates. I'm Johannesburg in Dubai. Two narratives this morning. We have, well, actually three narratives. A slightly more hawkish Fed. We had strong earnings, mostly coming through from the magnificent names that did report yesterday, with the exception of Meta. The action, the extended hours action there is slightly underwhelming. But all the other names, as we were just talking about, Alphabet, Amazon, very strong performance in after hours. And then the other narrative that's prevailing is what has been happening with oil, and a real expectation here that maybe we could see a resumption of hostilities and certainly no imminent lifting of that blockade around the Strait of Hormuz. So as you can see in front of me, risk has taken a bit of a dip to the downside. S&P futures now down 0.3%. NASDAQ also, despite the better earnings, also leaning towards red, down 0.3% as well. Brent up 6.4%. All of this has happened in the last couple of hours. And again, with another Axios report coming through suggesting that the head of the U.S. Central Command will be briefing President Trump on a bunch of different military options later today. So as we head into the weekend, certainly the oil market is accounting for the possibility of more attacks. Two-year yields also in focus, 3.94 is where we're at. During the Fed or throughout the course of the evening, as it became apparent that many policymakers were not comfortable with the easing bias, we had 3 dissenters on that front with the Fed. Two-year yields moved up about 11 basis points throughout the course of the day to account for that hawkishness and possibly even rate hikes to come, though the bar there seems to be a lot higher than it is for other central banks. And note, speaking of other central banks, we have the Bank of England and ECB coming up later today. All right, let's also check in on how markets in Asia are faring as well. Avril Hong is in our Singapore studio. Avril.
Yeah, Jumana, we have those headlines to contend with against the backdrop, of course, of those Mag 7 earnings that overall showed strong demand for AI. And then out of Asia, Samsung Electronics also showed similar, but you are seeing stocks down in the region, except for maybe pockets in tech, against the backdrop of these concerns that maybe the U.S. is mulling more military action in Iran that already is playing out in oil prices. And that is an extension, of course, as you well know, of what we got from the likelihood of that blockade being extended. So that hit bonds. You also had the Fed dissenters really not helping fixed income. You're seeing the 10-year yield in Japan highest since at least 1997. A lot of the repricing is on the front end of the curve. Today, we did get a solid 2-year auction, though, so maybe allaying some of those concerns. Aside from that, we're also seeing dollar yen still above the 160 handle, above 160.4 thereabouts. And that was a level that it reached just a day ago, the highest since 2024. So it's stocks, it's bonds, it's currencies that are getting affected in the region as we head into a long weekend for many of these markets as well. Jumana.
Avril, thank you. Yes, risk off, certainly the theme today. Avril Hong in Singapore. Now, the UAE's decision to quit OPEC has been driven by its worsening rift with Saudi Arabia. Abu Dhabi is now also considering its membership of regional bodies, including the Arab League and the Organization of Islamic Cooperation, and is reassessing its role in the GCC. Meanwhile, President Trump has welcomed the UAE's decision to exit the group.
I mean, I think it's great. Look, I know him very well, Mohammed, and very smart. And he probably maybe wants to go his own way. That's a good thing. I think ultimately it's a good thing for getting the price of gas down, getting oil down, getting everything down. They have it all. He's a great leader, actually. So, no, I'm okay. They're having some problems in OPEC.
First comments from President Trump after that bombshell decision from the UAE to leave OPEC. Joining us now is Karen Young, Senior Research Scholar in the Center on Global Energy Policy, Columbia University. Well, Karen, we saw minimal market impacts yesterday from the decision. Clearly, the market is very much focused on the short term, the fact that the blockade is still in place and developments within the Iran war. But let me just start off perhaps with a more medium-term question, which is, what do you think are the geopolitical implications of the UAE deciding to leave OPEC?
Well, thank you, Jumana. I think, this has maybe been a long time coming. There's obviously frustration in terms of the quota versus what capacity and investment has been for the UAE. But yes, geopolitically, I think there's been frustration with the efficacy of regional organizations in light of the war, in light of the shared threat, and the UAE taking a more independent stance. How that plays out into political organizations, we have yet to see. But this is certainly, I think, a preparation for what comes after in terms of economic independence, the ability to move quickly, to ramp up production, and to make decisions, for, the national security of the state. And other states will be doing the same thing, whether it's in energy security issues or on national security, military sort of considerations as well.
Yeah. What does a less influential OPEC mean for global energy stability, though?
So, I mean, this basically changes OPEC's, overall supply of global supply from about 50% to 45%. So it's not, such a huge loss. But I think it does, demonstrate that there are other players, the U.S. being the most important of those other players in the market. And so when we get to a place where we start to see hopefully flows through the strait and resupply getting to market, there will be a rush. And it just probably creates a bit more volatility and uncertainty in terms of price wise. So that's something we'll have to live through on the other end of this crisis, but we're still quite a ways from that.
Yeah. And we're still very much in the middle of the crisis. So let's talk about the price action this morning. Oil is significantly higher. Brent is trading almost at $126, up around $6, $7 just throughout the course of the last couple of hours. Some real concern, perhaps, that we may see a resumption of hostilities. How do you see the market developing from here onwards, should there be another round?
So I think, some of this price pressure is definitely structural. We're getting into these inventory draws, and I think the market really realizing that we're not coming to any sort of solution in terms of traffic in the strait. So that's driving price. But yes, we also had this meeting at the White House on Monday where President Trump met with advisors considering potential military options to ramp up the pressure against Iran. And there is another briefing scheduled on Thursday on military options. So this is, I think, the sentiment that we're at a stalemate. Neither side is budging. There's no ongoing person-to-person, in-person negotiation. And so military pressure may be the next step. We're also in this pattern. We're getting to a weekend. This is how this conflict has had a certain rhythm to it. And so we see the president often making threats that happen on the end of the week and then trying to then assuage markets on Sunday night, Monday morning.
I know this is a difficult question to answer, but assuming the strait does stay closed, say, for a few more weeks at least, and you do have a resumption of hostilities, how high could these oil benchmarks get to? And I'm just talking about the benchmarks here. I'm not talking about the products and diesel and so forth, which are already extremely elevated and trading at a big premium.
I don't think I'm equipped to say, but all the signs are up, right? So it can keep climbing. And we've had this sort of gradual price pressure. But I think now there's a realization that it will not be easy to even, in a more durable ceasefire, a more durable agreement, it won't be easy to get to that. That will take time. And the resumption of flows could take months and months even following. So price pressure just has to mount until we get to some demand destruction.
Yeah, ultimately, that's going to be the case. The Trump administration introduced several policy measures to help ease the blow of higher oil prices, including the release of that stockpile, the lifting of introducing a waiver on sanctions of Iranian oil and also Russian oil as well. Has the impact of those measures been largely felt now? And, is there anything more that the U.S. administration can do policy-wise to help support prices?
So the waiver on Iran expired April 21st, and we've seen more enforcement as part of the blockade on Iranian flows. On Russia, maybe it's a little bit of a different story. But, I don't know that we would see another relaxation on the sanction side. You could see potentially another coordinated SPR release, also through the IEA. They have, floated that as a possibility. But I think that would signal actually to markets the severity of the shortfall that we're experiencing. And it would actually be probably more of price pressure upward than it would to resolve, immediate supply, because those dispersion rates of the SPR are not so fast.
Karen, always a pleasure to chat to you. Thank you so much. Karen Young, a senior research scholar in the Center on Global Energy Policy, Columbia University. Thank you. Well, the U.S.-led war on Iran is now fueling a piracy resurgence off Somalia's coast. According to the EU naval force, at least 3 vessels were hijacked in the past week, raising fresh risks for a key global shipping route. Our chief Africa correspondent, Jennifer Zabazaja, joins us from Johannesburg. So what is driving this uptick in piracy? How is the Iran war actually contributing to this spike in piracy?
We're learning quite a bit about this, Jumana, and it really does drill down to what we are seeing in the Middle East and how, as we're hearing from this naval force, it's creating a noticeable shift in the region. So initially focus, of course, was on some of the Houthi attacks that we had been seeing off the waters of Somalia and in the Red Sea. Now more so, a lot of the focus, of course, has been on the Strait of Hormuz. And what we're hearing from the European Union Naval Force Operation Atalanta says that that is somehow creating a perception that security off of Somalia's coast is weaker, leading to increased incidents. And of course, Shimana, as you were just saying there, in the past week alone, we've seen at least 3 confirmed vessel hijackings. And the concern is that, are we potentially going to get to a point that we had seen a few decades ago where this area was largely seeing a number of incidents of piracy, especially because of the really split focus of the naval force in the region to the various incidents that are happening across the region itself.
And I guess one of the questions is, how seriously should we be taking this in terms of threats, again, to a very busy shipping route? I mean, we're talking about the effective closure of the Strait of Hormuz. Yeah. Should we be worried about this alternative shipping route as well, Jen?
And that's key, Jumana, right? Because as long as just because we've been seeing the strait disrupted for so long, some of these alternative shipping routes have become just as important. So the fact that we are seeing increased concern about them is creating what many of these officials are saying is quite a real security concern. They actually said the capability and intent of Somali pirate groups remains real. And we should talk about why the concern is that, because if we do continue to see this increased and we don't in fact have the security in place to defend these increased attacks, what does this mean, and who then steps up to potentially fight some of these incidents who are there? I should note, though, last year we did see Somalia pass legislation to defend and combat some of these attacks, but they largely depend on private companies and foreign naval forces to deal with this. So it's really a difficult situation for the country itself and also for the region that has implications worldwide, of course.
Yeah, for sure. Jennifer Zabazaja, our chief Africa correspondent in Johannesburg, thank you. Well, Kenya is considering tapping up to $600 million in emergency funding from the World Bank to cushion the impact of the Iran war. Authorities say the country could access the funds quickly under the Rapid Response Facility, though a final decision is yet to be made. Bloomberg News has learned that Airtel Africa is considering a London IPO of its mobile money business that could raise up to $2 billion. The listing could value Airtel Money as much as $10 billion, making it one of the largest recent offerings in Europe. Plans are still at an early stage, with details on timing and structure yet to be finalized. And coming up, decision day. Both the Bank of England and ECB are expected to leave rates unchanged today. We tell you what policymakers and investors will be focusing on next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bursachi in Dubai. The Bank of England is expected to keep interest rates on hold when it announces its decision later today. Policymakers are playing for time amid the standoff between the U.S. and Iran, and officials are having to balance the risk of a prolonged energy price shock against a subdued domestic economic picture. The ECB is also set to announce its interest rate decision later. The decision will be likely influenced by various economic reports, including the PMI's GDP, as well, of course, as inflation readings. Let's go to Frankfurt now and Bloomberg's chief European correspondent, Oliver Crook. So you've got sort of mixed bag of data, Ollie, don't you? On one hand, we had those shocking PMIs last week suggesting contraction. On the other, the inflation numbers seem to be moving in the wrong direction. How do they piece this all together?
That's the big question, Jumana, for policymakers that will be facing journalists and giving their rate decision here in Frankfurt at the European Central Bank. They set out last month there's sort of three possible scenarios for the war in Iran, the sort of the good, the bad, and the ugly, the base case, the adverse, and the severe scenario. The sort of base case scenario was seeing inflation peak at basically 3.1% in June of this year. The bad is September at 4.2%, and then the ugly scenario, March of next year at 6.3%. I think for everybody in the room, the question is going to be, which scenario are we looking at right now? Each of those scenarios has certain assumptions about the price of oil and gas. Right now, as we've been seeing this morning, oil shooting through $124 a barrel in Brent this morning. That puts you in the sort of bad scenario for the ECB. Last assessment we heard from Christine Lagarde, they said they were between the baseline and the sort of adverse scenario. So that is going to be the big question for policymakers who are convening here to face the press a little bit later today. We should say that the April data that we've been getting to get in inflation the last couple of days has all been moving higher. In Germany yesterday, we got 2.9%. We should say that was below the estimate of 3.1%. Spain hitting 3.5%. And today we're going to get France and a slew of other data. But of course, Jumana, we're not just getting CPI data today. Yeah. We're also getting GDP data. And I think one of the big questions for policymakers is, what is the bigger risk here? Is it to inflation or to growth in Europe?
Yeah, though, again, I guess with the ECB, they can say that they've got one major mandate, and that's price stability. Ali, I was looking at what was priced in terms of expectations, interest rate expectations. And for June, it's interesting because it's not just one full interest rate cut hike that's priced in. It's a little above that. There's about 29 basis points worth of rate hikes priced in. So it really feels as though the market is centered on the ECB hiking in June. What could change that?
Yeah, I think that really what's going to change that is the ECB's Governing Council kind of assessment of inflation. As you know, Jumana, as much as inflation has been studied by economists, every inflation shock is very, very different. And I think that there is probably some thinking within the ECB that if this is transitory, I know a trigger word in central banking for the last couple of years since the last inflation shock, that this is really a sort of inflation shock that is segregated to sort of energy and the headline inflation level, that maybe they can look through it for a little while. But again, there's a real question about what the pass-through is going to be. Is this inflation just going to be relegated to the energy sector? How much contagion is there going to be into wages, into sort of prices going up? As consumers expect prices to go up, that of course will allow companies to raise prices. These are all going to be the major questions for the European Central Bank. And we're going to have a real question about stagflation. How much growth is a threat? How much inflation is going to rise?
Ollie, thank you so much for the preview. Looking forward to it later. That was Bloomberg's Oliver Crook live in Frankfurt. Well, coming up, European bank earnings are in full swing with Crédit Agricole and BBVA set to report shortly. We've had Standard Chartered and BNP already, so we'll bring you a preview of the ones that are yet to report next. This is Bloomberg. Well, we are continuing to track a busy earnings week for European banks with Crédit Agricole and BBVA set to report shortly. EMEA stocks reporter Chloe Melly joins us right now. Chloe, so looking ahead, it's a big day for French banks' earnings. We have Crédit Agricole coming up. BNP just dropped. What are you watching out for?
Yeah, BNP and SocGen actually just reported this morning, and both of those have beat estimates, and they were really boosted by equities trading in particular. So we are just missing Crédit Agricole, which we'll be reporting in the next few minutes. But the problem with Crédit Agricole is that it does not have that same exposure to trading that those other two big French banks have, and so some analysts are expecting it to be quite a tricky quarter potentially for Crédit Agricole, with potentially lower insurance revenues because of recent storms and floods. There might also be some hit from currency headwinds, currency fluctuations. But more importantly, investors will be really looking at the impact of higher inflation and of geopolitical uncertainty on provisions, especially given that Crédit Agricole tends to have a more conservative outlook on those things. So we could see maybe a top up in provisions there. So cost of risk is really going to be in focus. And then for French banks in general, there's also going to be a focus on all of those exposures that have recently really worried investors, like commercial real estate and private credit and software. But all of that might come a little bit later in the earnings calls.
And we also have results from BBVA later today. What are investors expecting?
Yeah, investors are expecting quite a resilient set of results, actually, from BBVA. It's benefiting from currency tailwinds, from lower costs, and also quite a resilient trajectory for net interest income. But the big concern is really going to be around those loan loss provisions, especially given that BBVA has missed on that metric in the last couple of quarters, and that was driven by some weakness in Mexico and Turkey. And so the performance of those two is going to be really in focus. And the big question of those results, the big test, is whether BBVA can sustain that profitability even amid all those provisions.
Yeah. And actually, as you were speaking, Chloe, we just got the BBVA numbers. First quarter net income is a beat, 2.99 billion versus estimates of 2.81. First quarter net income also a beat, 2.99 billion versus 2.81. So another beat coming through from a European bank. Chloe Melly, thank you so much. I'm going to round up the show with a quick look at oil because it's all about oil this morning. Massive move upwards today, almost 5% higher as we set up for the European Open, and real expectations that we may be in for another round of hostilities around here in the region. That is it for Horizons Middle East and Africa. Daybreak Europe is coming up next.